Hey guys, I'm Roger Herring. I'm the Investor's Accountant, and thank you for coming by our YouTube channel. Before you leave today, be sure you hit subscribe and click the bell. That way you won't miss any of our free educational videos. So right now, click subscribe, hit the bell, and a great video is coming your way right now. Hey guys, I'm Roger Herring. I am the Investor's Accountant, and thank you for joining us today. You know, last week's video generated a lot of discussion over on Facebook, and we got a lot of questions. So I'm really glad that you enjoyed last week's segment on side streaming. What we're talking about are ways that we can protect our income from the IRS once the tax code changes next year by using C corporations. Last week we talked about side streaming, where we take a revenue stream and we put it in a separate company and run it side by side with our existing company. This week we're going to talk about a concept called upstreaming, which is a little bit different. So here we are. You have a company down here. This is your S corporation, and it's throwing off income. Now, here's the thing. With side streaming, the example I used was flipping and wholesaling, and we split the flipping off from the wholesaling. That's side streaming. With upstreaming, what we do is we take something that is not necessarily a separate revenue stream, but something we do within our own company. Here's an example. Let's say that you are into wholesaling and flipping, but you have an acquisition team inside of your company. What we would do with upstreaming is this. We would create a separate C corporation, and we would move the acquisition team from our S corporation and make them employees of the C corporation. So, here's your acquisitions. And what we do now is we bill the S Corp, and the S Corp in turn pays the C Corp. So what we're doing is we are moving revenue out of the S Corporation up into the C Corporation. This will flow through to our personal tax return. This will stay in the C Corp and be taxed at the C Corp rate. Now, a couple of things were thrown out last week. Right now, the C Corp rate is 21%. And people were saying, but it's going to 28%. Maybe. 28% is the proposal, but the president also indicated it during negotiations that he would be willing to keep the 21% rate if there was a minimum tax rate for large corporations. But regardless, if you're in the 39.6% tax bracket here, wouldn't you rather be in the 28% here? That's upstreaming, guys. Now, in future weeks, we're going to talk about a number of things. We're going to talk about sandwiching, which is a technique that we use with short-term rentals and profitable rental property. We're going to talk about C Corp 101, the basics of utilizing the C Corp. Next week, we're going to talk about tax rate splitting. Tax rate splitting is why a small to medium-sized investor wants to use the C corporation for their ordinary income. I can't wait for it. Until the next time, gang, Roger out.